Palantir has become one of the most talked about technology companies in the stock market during 2025. In recent weeks, its stock price has faced a sharp decline, falling in step with a broader pullback in high-growth artificial intelligence companies. This decline has been linked to growing concerns about valuation across the entire artificial intelligence sector, which has been under pressure as investors worry that prices may have risen too far too quickly. Even though Palantir shares are down by nearly 20% compared to their recent peak, they still remain highly valued by traditional standards. The stock currently trades at a forward price-to-sales ratio of about 90 times, which makes it among the most expensive names in the technology space in the second half of this year. Despite that steep valuation, some investors and analysts argue that Palantir remains a compelling choice, especially for those who are comfortable with higher levels of risk. Tyler Radke, a research analyst at Citi, emphasized in a CNBC interview that Palantir is practically indispensable for businesses that want to successfully adopt artificial intelligence. This step is where Palantir provides a critical advantage. According to Radke, this unique position is one of the main reasons why Palantir has performed so strongly throughout 2025. Radke further pointed out that Palantir delivered one of the most impressive earnings surprises and upward guidance revisions seen in years when it reported results on August 4th. He credited this outcome to Palantir's durable competitive edge, often referred to as a moat, which sets the company apart from peers. In his view, Palantir is particularly appealing as a long-term investment because it has few, if any, direct competitors that can match its ability to organize and structure data. He summarized that Palantir represents a rare and powerful combination of software capabilities and service expertise, placing it in a category of its own for now. Other analysts have expressed similarly optimistic views. Wedbush analysts, for example, believe that Palantir has the potential to join the elite trillion-dollar market capitalization club. They argue that focusing solely on valuation is short-sighted, since many groundbreaking technology companies in the past looked expensive at first glance, but ultimately went on to deliver enormous returns for shareholders. At the same time, not all Wall Street firms share this enthusiasm. Some remain skeptical, maintaining that Palantir's valuation is far too high to justify new investments. For these firms, the disconnect between price and fundamentals continues to be a reason to stay cautious. Looking at Palantir's track record in 2025, it is easy to see why it has become such a polarizing stock. According to data from Barchart, Palantir's consensus analyst rating is currently hold, with an average price target of about $156, which is very close to where the stock was trading as of Thursday. Even so, Palantir has managed to deliver one of the most remarkable performances on Wall Street this year. In fact, it became the single best performing stock in the S&P 500 index, climbing over 106% and at one point reaching gains of 144% since the beginning of the year. This surge even outpaced major artificial intelligence companies such as Nvidia. Much of this growth was driven by strong financial results. Palantir achieved its first ever billion-dollar quarter thanks to rising momentum in both its government contracts and its commercial artificial intelligence business. Investors flocked to the stock, viewing it as a clear winner in the artificial intelligence boom. However, the story took a sharp turn in recent weeks. Over a span of only 6 trading sessions, Palantir shares plummeted by more than 17%, erasing $73 billion in market capitalization. This was the largest drop for the company since April, and served as a painful reminder of how volatile high-growth stocks can be. This steep decline provided a major win for short sellers, who collectively pocketed about $1.6 billion in profits during the sell-off. Still, this figure pales in comparison to the $4.5 billion in paper losses that short sellers had accumulated earlier in the year when Palantir shares were climbing. The stock's sharp reversal left it as the worst performing name in the S&P 500 in recent days, showing just how quickly a market favorite can fall out of grace. One of the key forces behind Palantir's decline has been renewed attacks from well-known short sellers. Citron Research, led by Andrew Left, issued a particularly critical report. In this report, Citron argued that Palantir's stock had become completely detached from its underlying business fundamentals. To underscore their point, they even released a cartoon portraying Chief Executive Officer Alex Karp in the Royal Court of OpenAI with the title Your Highness's Multiple, suggesting that Palantir's valuation had become absurdly inflated. Citron's main argument centers on comparing Palantir to OpenAI, which is widely seen as the current leader in artificial intelligence. OpenAI is expected to secure a valuation of about $500 billion, with forecasted revenue of $29.6 billion in 2026. That would imply a price-to-sales ratio of nearly 17 times. In comparison, Palantir is estimated to produce about $5.6 billion in revenue in the same year. Using OpenAI's multiple, Palantir's market value would come out to around $95 billion, which translates to a stock price of roughly $40 per share. Even at that lower price, Palantir would still appear expensive, especially when considering that OpenAI's multiple itself is at the very high end of valuations in the software sector. They further argued that Palantir's reliance on government contracts and customized deals makes its business model less scalable and less subscription-based than Wall Street prefers. This stands in contrast to OpenAI, which they described as building a self-reinforcing growth engine that compounds like Google in its prime. By contrast, Palantir was described as essentially locked-in consulting work packaged with software, which limits its growth potential. This comparison painted Palantir as fundamentally different from OpenAI. Citron included charts that contrasted Palantir's steady but moderate revenue growth with OpenAI's explosive and accelerating trajectory. The dramatic swings in Palantir's share price throughout 2025 offer a clear case study of how market euphoria can push a stock to extreme levels before valuation concerns cause a swift correction. But once investors began taking profits and negative reports circulated, the momentum quickly vanished. Now the stock finds itself caught between bullish investors who see it as a unique long-term winner and bearish critics who view it as dangerously overvalued. It is worth noting that volatility in Palantir shares has also been amplified by a broader pullback in the technology sector. Many artificial intelligence-related stocks have faced similar pressure, especially after new research raised doubts about the immediate potential of the artificial intelligence revolution. A recent study from MIT revealed that 95% of corporate pilot programs involving generative artificial intelligence are failing, despite tens of billions of dollars being spent on them. This has led to questions about whether the current wave of artificial intelligence enthusiasm has outpaced practical results. The conversation around an artificial intelligence bubble has also intensified. Sam Altman, the chief executive officer of OpenAI, openly stated that the artificial intelligence market may already be in bubble territory. The leader of the most valuable artificial intelligence company in the world is acknowledging the risks of market froth. They emphasized that Altman is not shorting Palantir, but rather pointing out the broader reality that valuations have become dangerously inflated across the sector. As of now, Palantir has not responded to these criticisms or issued any official statement. Investors remain divided, with some continuing to bet on Palantir's long-term growth potential, and others warning that its valuation leaves it highly vulnerable to further declines. Regardless of which side proves correct, Palantir's story in 2025 serves as a vivid reminder of how quickly fortunes can change in the stock market, especially for companies tied to hot trends like artificial intelligence. Essentially, according to these articles, Palantir has had a dramatic year in 2025, soaring to become the top performer in the S&P 500 with gains of over 106% at its peak, driven by its first billion-dollar quarter and a rising demand for artificial intelligence contracts. But more recently, it has faced a sharp reversal, with shares plunging over 17% in 6 sessions, erasing $73 billion in market value. Supporters like Citi's Tyler Radke argue that Palantir is indispensable for businesses adopting artificial intelligence because it helps organize data, and firms like Wedbush believe it could join the trillion-dollar club. Yet critics led by Citron Research insist the stock is severely overvalued compared to leaders like OpenAI, and warn that its reliance on government contracts makes it less scalable. This sharp divide reflects the broader debate over whether the artificial intelligence boom is sustainable, especially after reports showing that most corporate pilot programs are failing, and even Sam Altman of OpenAI has admitted that the market may already be in bubble territory. For more stock news updates, remember to press the like button and subscribe. With that being said, I will see you in the next video.